Peace family, what's good? Doug Washington here with another episode. And if you're new here, I do two things. First and foremost, I ensure that everybody eats. And secondly, I make the banks compete to lend you money. And on today's Ultimate Credit Masterclass, I want to break down a few things to you for you to maximize the amounts that you approve for going forward from 2025 and beyond. I'm going to be breaking down a few things today, and you're going to be able to leverage this information, family, to take your family's purchasing power to that next level. The first thing we will be discussing is proper relationship building. As we all know, building the correct relationships will get us access to the maximum exposure lines, will get us access to multiple products. All of these things will be very beneficial to you along your relationship building process. Secondly, we're going to be discussing the quality of your profile. As we all know, whenever you go for a credit card, banks are going to pull your bank card score. Whenever we go for an auto loan, they're going to pull your auto score, right? So there's different weighted factors upon each individual FICO. From here, we're going to be discussing how to strategically credit stack to obtain $100,000 from each bureau. Mind you, there's 3 bureaus. So if you go and get $100,000 from each bureau, and there's 3 of them, listen, y'all can do the math, family. Y'all here with me. And we're going to be discussing how to audit the bank to determine which one should you focus on. Just because the institution offers a business credit card, that don't mean that you should go for it. Just because the institution offers a personal line of credit, that doesn't mean that you could go for it with that specific institution. So we're going to learn how to audit the banks to determine which banks that we should be asking for each product. And lastly, I got some game for y'all. Watch until the end for my secret strategy I use to obtain over 7 figures in funding. Based on data from the SLOOS, the Senior Loan Operating Opinion Survey of Bank Lending Practices, banks are still tightening. Despite what anybody else is saying, banks are consistently tightening, and they're making it hard for us to get access to capital, family. I'm not gonna lie to you. So what does this mean for the average American? It's going to be harder to get access to capital to grow and scale your business and or personal brands. But more importantly, how did we even get here? And that's a long story, but I'm gonna make it real brief. Banks operate off what we call fractional reserve lending. And if you're familiar with fractional reserve lending, this is where you go and put $10,000 into an institution, and up until 2020, they had to keep a 10% reserve ratio. But guess what? When COVID came, the Fed lowered the reserve ratio from 10% to 0%. So that allowed the banks to lend out recklessly. And I talked about that on my previous episode when I really went in detail on it. But banks operate from fractional reserve lending, and once they got greedy and they lended out to the unqualified business owners, etc., it made it harder for them to lend out more money because everybody was running off on the banks. If you go and look at the default ratios, you'll see that we are the highest that we have ever been, meaning that people are not paying their credit card bills. People are running off on the bank, they're getting access to capital, and they're not paying it back. And it's going to affect us business owners, right, who does things the right way. So with all of this being said, risk tolerances are lower, exposures are lower, and requirements are higher, meaning that how we used to be able to go and get access to $100,000, $150,000 with no documentation, banks may now start requiring documentation for even as little as a $25,000, $30,000 limit credit card. But due to the default ratios, we got to understand, family, this is essentially what we expected to happen. So with all of this being said, family, it's a lot of changes coming. So some notable changes that's happening in beginning of July 2025, business relationship managers with Chase can no longer operate outside of their book of business. Typically, we were able to get a BRM from Chase, and then they were able to help us get clients funded $50,000, $100,000, $150,000, right? But now they can no longer operate outside of their book of business and or the state that they're in. So if you have a BRM that is in Florida, if you have a BRM that is in South Carolina, Georgia, etc., they can only operate within that certain state unless they have been given certain requirements to operate outside of those states, right? So currently, reps are recommending that you don't do any more than one product every 6 months. Wow, you still can go and get access to both credit cards, but for best results, as a rule of thumb, I would recommend you to kind of follow the rules in which they have in place. Now, it was only a matter of time as the default rates continued to rise. People were getting access to these high limit credit cards and they weren't paying the money back. So with JP Morgan and Chase being the largest bank based on assets, many other banks and credit unions are going to follow suit, family. So understanding the climate is critical for us to audit the banks and determine our funding sequences. We have to be laser focused and super strategic with our funding sequences to maximize the capital that we are going for, right? So leverage this information that I'm about to discuss with you to increase your family's purchasing power, family. So the first thing that I want to jump into today is relationship building. How do I properly build a relationship with the banks? That is a question that I get asked a lot. So understand there are multiple ways to build, but the one in which you are solely in control over is your deposit relationship, because nobody can tell you how much to deposit into the bank. Only you know what liquidity that you have available to you before you can deposit into these institutions and start building this deposit relationship. So banks have an internal bank score that they categorize you based on your average daily balance. Once again, this is an important part of the relationship building process. And the more products that you have, the higher your internal score will be. But what we do is we leverage deposit relationships with multiple products to insinuate that we are going to be with this institution for years to come, right? We're flexing our staying power with them, because if you go in with a personal checking account, a personal savings account, a business checking account, a business savings account, a CD, a shared secured loan, right? This insinuates that you intend to be with this institution for the long term, and all in reality, we're playing our hand correctly. If I was starting from scratch, I would start with a personal and business checking account and saving account. Now, this insinuates, like I previously stated, that you are wanting to be with them for the long term. Understand, whenever you go through and you open up this business checking, business savings, personal checking, personal savings, what's going to happen is the banker is going to try to push you to apply for a product. Understand how the bankers are being paid here. They are not paid on the amount that you are approved for. They are paid on the number of approvals. So they could care less whether you get $1,000 credit card or $100,000 credit card. They're wanting you to get as many products as possible so they can fatten up their pockets. Now, for us as the business owners, as the entrepreneur, etc., what we want is high limit business funding at 0% interest. That's the most ideal form of funding for us. But for some of us, we want personal funding. But the main thing that we all want, family, I think we can agree with each other here, is that we all want access to high limit products, high limit credit cards, high limit loans, high limit lines of credit, etc. So whenever you're going in and you're building out this deposit relationship, and remember, it should be built out over a 90-day period. You want to simply state that you aren't in any rush to apply for any new products, and that's what I'm here to do, is build out my internal relationship with you guys, right? Because they're going to be pushing you to apply for new products. Now, while you could be approved for the product, you will be nowhere near the maximum exposure as you haven't built out that internal rating with that institution. We want to build out an internal score of a low 5, family. Now, a low 5 is a $10,000 average daily balance. What we do is we liquidate money off of other credit cards to build out this internal relationship, or this deposit relationship rather. Now, increase consistent deposits as you get closer to the 90-day mark is very, very key. So if I was starting a brand new relationship, for the first month, I would do $500 a week. Then for the second month, I would do $1,000 a week. And then for month 3 to close out this internal deposit relationship, I would do $1,250 a week. And if you do according to these deposits, right, you have right around $10,000 liquid capital sitting in your account. And then if you want to go for funding on day 90, on day 91, etc., you have properly positioned yourself to get access to some high limit funding. Because remember, family, we built out a deposit relationship to make it look as if our business is profitable, but all we did was pull the money off of a credit card. Now, you do not want to drop $10,000 into this checking account and then just let it sit. you now will have a dormant account and you're going to be affected by it because you just put the money in there and let it sit. You didn't increase your deposits as you got closer to that 90-day mark to seem as if your business is profitable. For all they know, you could have took out a loan or you could have got a reward. You could have hit the lottery, right? And just put $10,000 into the account. This doesn't mean that you're running a lean business. So once again, we want to build out a deposit relationship with these institutions before we even ask them for anything, right? Now, depending on your level of liquidity, we can leverage multiple banks or credit unions with this strategy. And this is also known as structuring future funding rounds, because you know when you're going to go and apply for this credit card. So building out on a 90-day cycle, on a 120-day cycle, upwards of a year-long cycle, this puts you in a driver's seat to determine the high limit credit card that you're going to be approved for. Now, if you have business credit cards at 0% APR, family, this is the go-to. As you liquidate the money off of the business credit cards, it's not going to report to your personal profile, and then you can leverage multiple different relationships per $10,000. So for every $10,000, this is equivalent to one banking relationship. $10,000 should be deposited over a 90-day period into bank one. If you have $20,000, another $10,000 will go into a separate institution within your funding sequence, right? If you have $30,000, this will go into the third different institution depending on your funding sequence. So once again, for every $10,000, this is going to be one banking relationship. But if we understand the application rules, we can maximize the amount of funding that we can get, because PNC, Bank of America, right? Chase, American Express. These are institutions that's going to have multiple business credit cards. And then if we go in with a $10,000 deposit relationship, leverage that, and then go and apply for 2 credit cards on the same day, you could be approved upwards of $20,000, $30,000 just off of this $10,000 deposit relationship. So we're going to get more into that. But for right now, I want to discuss the quality of the profile, right? I want everybody to understand this. Banks and underwriters are judging you based on the accounts that you got on your profile, family. So I'm going to scream this from the mountaintop. We do not add credit builders to our profile. We do not add net 30s to our business profile, right? Very, very important. So the quality of the profile is dictated by the quality of the accounts that you have on there. If you have credit builders and low limit accounts, the banks will reciprocate this energy to you, right? This is why we build internally with each bank to create our own identity with them. A 90-day deposit relationship will outweigh any credit builder account. I don't care how large the limit is on it. A 90-day deposit relationship is going to trump any credit builder account. You can leverage shared secured loans multiple times. I broke this down in another video on the channel too. I talked about how we can take $10,000 and structure up to $25,000 to $30,000 worth of primaries on our profile. So definitely go and check that out. The link will be in the description for everybody. Now, I always use this analogy. With the quality of the profile, look at that as your transcript. You can have a 4.0 GPA with a whole bunch of electives on your profile, or you can have a 3.5 GPA with a whole bunch of advanced placement courses, which is going to look better to the underwriter. Quality or quantity, the 4.0 or the 3.5, right? So I always put this analogy together to let you see how the underwriters are viewing your profile. Nobody cares about the 4.0 GPA you took PE, you took a whole bunch of electives. Once again, underwriting is key whenever we are credit stacking. And remember, we are playing the long-term game here, family. So structuring the relationship is key. Underwriting is key whenever you are credit stacking, and we're going to get more into this on the bank audit section. I just want everybody to understand the quality of the profile and then the weight that it holds. We don't care about our credit score, as our credit score will never outweigh our profile. Now, credit stacking. If you are familiar with credit stacking, this is the process of applying for multiple products within a strategic sequence to maximize the overall amount funded. So if you build a deposit relationship and you have quality comparables over a 90-day period, this is going to put you in the driver's seat to obtain maximum exposure from a lot of these banks, from a lot of these credit unions. And that's what we're here to do. Now, you have to understand what banks to apply to in what order based on several factors, based on the application rules, based on the documents required, based on the bureau that they're going to use. All of these things are going to be very important whenever you are credit stacking or structuring your future funding rounds to get maximum exposure. Now, depending on your liquidity, I recommend building with 3 banks per bureau. And here's a mini funding sequence that I'm going to give to you for each bureau. So for Experian, you have Wells Fargo, you have PNC, you have FNBO. The thing about these specific institutions is they have personal and business products, and on top of that, they do their own underwriting. So what happens when people are doing a credit stacking sequence is they go to Coosa Valley, they go to Renaissance Bank, they go to LRG Credit Union, right? A whole bunch of different credit unions, but the underwriter is the same because they are the issuer of the credit cards. I need y'all to understand that. So for Experian, we have Wells Fargo, PNC, FNBO. For Equifax, we have Truist, Chase, and we have Citizens, right? And the good thing about each one of these institutions is they're going to offer both personal and business products, and they do their own underwriting. And if TransUnion is your strongest profile, we have Bank of America, we have Regions, right? And we have US Bank. Now, the reason why I gave you this specific set of banks is because they do their own underwriting. They also do personal and business funding. So if you go to the institution, start on the personal, then graduate to the business in 6, 9, 12 months, they're going to reciprocate the energy that you gave to them. They're going to be approving you for high limits, assuming that you are responsible with the limits that you had on the personal side. Whenever you are running your funding sequence, you can fund yourself horizontally or you can fund yourself vertically. There's no right or wrong way to do this, but there's pros and cons to each way. Now, if you fund yourself vertically and you're on the personal side, what's going to happen when other institutions pull your credit bureau, whether it's Experian, TransUnion, or Equifax, what's going to happen is they're going to see that you have a list of new accounts for that specific bureau. Now, some people will go and fund themselves horizontally to where they go to one bank from Equifax, one bank from Experian, one bank from TransUnion. Therefore, you only have one inquiry across all of the bureaus. Now, if we're on the business side, family, this will not matter as we're able to remove the inquiries as those accounts does not report to our personal profile. But remember, family, underwriting is very, very key. Now, as we transition to bank auditing, this is how I make the banks compete to lend you money. And bank auditing is so pivotal that a lot of people skip over. And if you're not familiar with bank auditing, this is just ensuring that the institutions that we go to, they're the correct fit for us. I previously stated, just because a bank offers a business credit card, that does not mean you should go for the business credit card with that institution. Just because they offer a personal line of credit, that does not mean you should go for a personal line of credit with that institution, right? So just because they offer the product, that doesn't mean that this is the correct institution to obtain that product. We should go to institutions that specialize in specific products. Whenever I think of personal funding, I think of credit unions like DCU, PenFed, Navy Federal, right? Whenever I think of business funding, I think of some of the larger banks like Chase, American Express, right? PNC, because I know what type of lending do you specialize in. That is very, very key. But even outside of understanding what type of product that you specialize in, the first step, be familiar with the primary bureau that they use for lending. Do you lend from TransUnion, from Experian? Do you lend from Equifax? But even outside of the primary bureau that they use for lending, we have to be super strategic and understand, based on the product, what bureau do you use? PNC, for example, if you go for a business credit card, they're going to pull Experian. But if you go for a business line of credit, they're going to pull from Equifax. You have to ask, what primary bureau do you use for lending? And inside of that question, you want to know, for each product, what bureau do you use? From here, we want to know, what documents are required for each product? Sometimes if you're going for a business line of credit, what happens is they want you to have 1-year tax returns. They want you to have 2-year tax returns. They want you to be 1 to 2 years in business. So you have to understand the required documents and the qualifications of the business to obtain a business line of credit, to obtain a business credit card. And sometimes, depending on the type of credit card that you're going for, $100,000, $150,000 lines, what's going to happen is they're going to pretty much say that you have to be in business for a year. So you have to ask what are the required documents and what are the requirements to obtain funding for each individual product. Now, from here, we want to know what documents are required for the maximum exposure, because there's a thing as the total max exposure and the product exposure. The product exposure will be for you wanting to obtain the max exposure for a credit card, which could be $100,000. They'll have a specific set of requirements to obtain that $100,000 on that credit card. But if you were to go for $75,000, if you were to go for $50,000, those requirements may be lighter. You may not have to provide 1 year tax returns. So whatever they're asking for, ask them, is this the requirement for the maximum exposure, or is this the requirement for any type of lending? Now, once we understand the maximum product exposure, we now want to understand the overall max exposure. So what is the overall exposure across all lending products that I can get, and what is the ceiling that you allow me to have? So some banks will cap you at $250,000. Some banks will cap you at $75,000. Some banks will cap you at $100,000. You must ask for each institution for total max exposure. Understand what FICO score do you use for lending. Once again, if we're going for credit cards, they're going to pull your bank card score. But within your bank card score, there's different versions. You have your FICO bank card score 8, you have your FICO bank card score 3, you have your FICO bank card score 2. So depending on what institution that you are applying for, they may pull a different version of your FICO bank card score. If you're going for auto loan, they're going to pull your FICO Auto Score 5, your FICO Auto Score 2, your FICO Auto Score 3. With each institution or credit union, you need to ask them, what version do you pull? From here, we want to understand what is the application rules. Application rules are very important. A few notable ones are Chase's 524 rule, their 230 rule, Amex's 5-card rule, Barclays 313 rule, Bank of America's 234, 312 rule, 712 rule. All of these are application rules that you must understand to save yourself from future denials. You understanding the application rules and knowing when to apply, knowing how many products to get is going to greatly benefit you within your funding sequences. Now, outside of the application rules, we want to know how many products can I obtain per inquiry. This is very important. If an institution offers multiple credit cards and they can pull your credit one time and you can go in and apply for 3 or 4 different credit cards like you can with Truist, this is how we're going to maximize our funding rounds. And the number one thing that we're here to do, family, is maximize the bag. Once you understand how many products that you can obtain per inquiry, we now want to understand if there are any geo restrictions. Do you only operate within a certain geographical region? Do you only operate within a specific state? And if so, how do you feel about foreign entity filings? Because I get this a lot from my clients, is they'll go out, they'll get a foreign entity filing, meaning that you basically file to do business in other states. Now, whenever they get to these institutions and they're trying to get access to $50,000, $100,000, the bank may not have a foreign entity exposure. So you must ask, what is your foreign entity filing exposure? Do you like them? Do you not like them? What is the radius of the mailing address that I have to be close to, etc.? Because none of this means anything if you go and get this foreign entity and then you can't get capital or access to funding at the states in which you want to operate in. Once we understand a foreign entity filing exposure, how do they feel about them? We now want to know, which this is so good right here. We now want to know, how do you feel about my specific NAICS code? I think this goes over a lot of people's head, is that based on your NAICS code, they're judging you based off of the previous relationships that they had. Nothing against you, but based on the previous history, people that come in under this NAICS code does not like to pay this institution back. So make sure whenever you are building out with these institutions, you ask them, how do you feel about my specific NAICS code, marketing consulting, general management consulting, administrative consulting, if that's your respective industry. So understanding the NAICS code and do they deem it as high risk is a very important question. Now, underwriting, I spoke about this previously. Ask the business relationship managers, ask your personal relationship manager, who does your underwriting? Is it in-house? Is it third party? Because if it's third party, you must understand who the underwriter is to make sure that you have not exceeded that underwriter exposure. Remember, Eline Financial, 3 products. Once you get past 3 products with them, you'll either get a denial or very, very low limit. So we must understand, do you do your own internal underwriting or do you outsource it, also known as third party underwriting? And then the next question, this is so good right here. At what amount do you file a UCC1 if this is a business product? Some of you may go out and you want to obtain large limit funding, but you may not want to get it all from one institution, as they will file a UCC1 on your business, which is essentially a lien. So if you go out and get access to $250,000 from Chase, they put a UCC1 on your business. What now happens whenever you go to PNC, whenever you go to Bank of America, whenever you go to Wells Fargo, whenever you go to American Express, whenever you go to other institutions, they're not going to want to lend to you their max exposure or what you should even be qualified for, because someone already has a lien on the assets. So make sure you ask what amount will require a UCC1 filing. That is very important. Now, while some of us may not be there in our business, other people are. And if you do get a UCC1 and then you service this debt properly, you now can file for a UCC3. And this is where we talk about building true business credit. Once again, if you are in position and you want to build true business credit, it may be more beneficial to you to get a UCC1 in hopes that you can then turn it into a UCC3 and get this high limit primary on your business profile. Once we understand what amount will require UCC1, you want to know what data do you report to the Business Credit Bureau. Some institutions will only report negative activity, while other institutions are going to report the average balance. They're going to report the payment trends, etc. And speaking of payment trends, let me give you a little bit of game here. I was not expecting to go this in depth with it, but depending on the payment trends over the past 3-6 months dictates how the banks lend to you. If you go out and you make the full payments and you do this every single month, month in and month out, right? And then you go and max the credit card out, and then over a 3 or 6 month period, you're only making the minimum. This makes you look risky to other lenders, as the banks, especially on the business side, are going to be reporting the business credit usage. Not a lot of people talk about this because we were always accustomed to getting access to business credit cards, moving our personal utilization over to the business side, and then hiding that debt with the business. Well, now, whenever we go for other business credit cards or other business products, banks are pulling our business credit and they are looking at the balances being reported. So know the difference between a true 0% business credit card and just a regular business credit card at 0%. There's a major difference. So listen, family, I just want to come through tonight and break this information down to you for you to put your family in better position, for you to increase your purchasing power. If you thought this was some gems, man, you ain't seen nothing yet. But listen, family, I appreciate you for tapping in with me. I'm Doug Washington, and I do 2 things. First and foremost, I ensure that everybody eats. And secondly, I make the banks compete to lend you money. Until next time, I'm out. Peace.